You are listening to ChartingWealth.com's weekly review and forecast for the week beginning Monday, the 25th of January, 2016. How do we always start? Well, we start with IYY, as we do every day and every time we do our weekly review and forecast. IYY is what? It is the iShares Dow Jones U.S. Total Market Index Fund. In other words, it tracks the whole market. It's not the Dow Jones Industrial Average. It's not the Standard & Poor's 500. It is all the stocks in the market. So it's as broad as you're going to get. What do we see going on? Well, we see that the market crossed over the first week of the year, crossed over going down on the weekly chart. It had already crossed over on the chart we use every day, our 2-day chart, back on the 4th of December. But it actually made a big crossover going down on the week ending the 8th of January. And what we saw happen was the derivative oscillator had already crossed over actually a couple of weeks before, around the week ending on the 24th. And the market continued to push down. Actually, the market closed below the Bollinger Band. Now, what is a Bollinger Band? For those of you who are just learning about what we do here, we track the markets using the charts. It's like going on a trip and taking a map with you so you know where you're going. That is why we pay attention to this. We talk about pay attention to the charts, not the noise. The noise is all the media hubbub you hear, all the things out there that can confuse you. The charts are rarely confusing. Now, sometimes you can be misled by them, but again, that's why you need to pay attention every day, to spend just a few minutes with us, just a few minutes looking at the charts, just a few minutes making some decisions on making virtual trades. And virtual trades are, of course, opening a brokerage account at any brokerage firm, putting some virtual money in there, become a virtual millionaire, and then learn how their software works to where you can set up buying and selling ETFs, stocks, options if you want to go that route, whatever, and just start learning how that works for free with virtual money. And then you can start seeing how, because there's nothing like doing real trades. When I say real trades, real virtual trades, actually going through the mechanics of making it happen online so that when you do get good enough to start using your own money and making your own decisions, you already know how to do it. You don't have to learn the stupid little things like why you might never use a stop, which I've never used. A stop loss order, I just don't do that because the minute you do that, guess what happens? Your order goes in as a market buy and means that the market maker can sell you out at whatever he wants to do with that, depending on the market, the time of day, and everything else that's happening. So it's those little tricks you learn when you start own your own, getting in there and doing virtual trades. So getting back to our charts, IYY confirmed down move 3 weeks in a row. Big down movements, so big it's actually pushed below the Bollinger Band, which, as I was starting to get to before, are volatility bands. It's like whenever the market gets outside the Bollinger Band, it always comes back in because it's like a big rubber band. But right now, it is outside that. Confirmed down moves on the weekly chart. Now, if we go back and take a look at what happened throughout the course of the week on the daily chart, the week started, of course, on the 19th. It was a shortened trading week because of Martin Luther King holiday. Market was up a little bit on the 19th, way down on the 20th, up some on the 21st, and a big up day on the 22nd. Not crossed over on the daily chart yet, and it's not crossed over, when I say that, not crossed over on the MACD, the Moving Average Convergence Divergence, which is our big indicator that we use. It's a great one. We like it. We keep it simple. We don't have like 10 of those. You could have 10 different indicators and confuse yourself to the point you didn't know what was going on. You'd never do anything. So we keep it simple. We use one indicator really. We like the derivative oscillator just to give us a little backup, but it's the MACD that's our big indicator. It's got its shortfalls too. So does everything. So the fact is, you find something that works and you stick with it. We like trend lines. We like Bollinger Bands, we like the MACD and the derivative oscillator, and we love candlesticks. We use the Hinkiayashi type candlesticks that you can also read about. You can go to our website, chartingwealth.com. Dearth of information, great videos, and we love you to go there. Sign up for our newsletter. watch the videos. It's all for free. Now, what we see happening is we see an up move, not yet crossed over. Derivative oscillators not flipped yet, but the end of the week showed some promise that maybe the down movement is stopping. Now, I don't believe that. I believe it's just the market digesting a whole hell of a lot of losses since the beginning of the year, but we shall wait and see, because what I think doesn't matter. What you think doesn't matter. What matters is what the charts tell you. And right now, they're just telling you that the market's moving up a little bit. Nothing confirmed. We don't have crossovers yet on any of our bigger charts. So we don't get excited about the market turning. It could just be nothing but a dead cat bounce. And what is that? That's when the market pops up a little bit. People are able to sell out their positions, or dummies are able to jump in thinking the market's going to go back up again, and then it rolls right back over like a dead cat. It bounces once. That's it. So could be that. Now let's go back to our weekly chart and see just what's going on in the SPY. It too, 3 big weekly down candles crossed over going down at the beginning of the year. Oh, I'm sorry, I didn't go to the SPY, I just went back to IYY, but it looks very similar. Why? Because the SPY is a Standard & Poor's 500, which is a large amount of the volume of the market. It is different, it's not exactly the same as the total market, but that's why we look at both. It is smaller, it's only 500 stocks, but it's 500 big stocks, big volume. We see it going down also, like I just said. If we go back to our daily chart, we can see that, yes, Tuesday, when the market opened after the Martin Luther King holiday, up a little bit, down big time on Wednesday, and then up Thursday and Friday, still not recovering from where it started moving down on the 19th, I get. Well, it's not even recovered to where it ended the prior week on the 15th. So we'll just continue to watch. That's where it is, not crossed over on the daily or the weekly, going up. Still confirmed down moves on both the daily and the weekly charts. Don't be fooled by what you hear in the media. Yes, the market was up. The total market was up over 2%, as was the S&P 500. The Qs, which is the NASDAQ 100 that we're going to next, was up a full almost 3%. But when we look at what's happening with the Qs, it too is in confirmed down moves since the beginning of the year. 3 big down candles showing us 3 weeks of down moves. And if we go to our daily chart on the Qs, again, the NASDAQ 100, the technology stocks, interesting, we do see a crossover on the derivative oscillator toward the end of the week. Chart looks very much the same as we saw on the total market and the S&P 500. Up move on Tuesday, big down move on Wednesday. A little bit of an up move on Thursday, and then a lot of up movement on Friday. Still not crossed over on the MACD going up. We may just see some digestion after all these losses. When the market eats a lot or vomits a lot, as it's been doing, it does rest. Sometimes it'll pop up a little bit, sort of like feeling better. Think about this. If you've ever had too much to drink and you start getting sick and you vomit and lose everything you had in your stomach, it feels good for a little while after you've had all that loss, right? But then you start feeling bad again. That's what we're talking about when we talk about a dead cat bounce. We might start vomiting again after a bit of an up move. We don't know yet. We're just watching. Now, lastly, we're going to go back to our weekly chart, and we're going to look at gold, GLD. And what do we see in gold? Well, gold crossed over on the weekly chart back on the week ending the 8th of January, and has continued 3 weeks of up movement. Derivative oscillator has switched over, and the MACD switched over. That is where gold is. It bounced off its bottom, which we established at about $100.50. And again, remember, GLD tracks gold at 1/10 of what it's actually trading for in the market. GLD is an exchange-traded fund. You can buy it every day of the week. Of course, we want you, if you're interested in being able to learn to track gold, to buy it virtually. Go buy virtual shares and see how well you can do with it. If, of course, you're going to short it, you can buy virtual shares in the inverse gold. So, again, play with those things and start figuring out how it really works. Now, one thing that's worked worked very well for us in the past has been the 4-hour chart. We looked at that. If you want to hear what the 4-hour chart's showing in gold, be sure to listen to our daily podcast for Monday, the 25th of January. We just recorded that and it's been posted. But what do we see going on the daily chart on gold? Well, we saw at the beginning of the week on Tuesday of last week, the 19th, gold was down. Big up day as the market crashed down on Wednesday. Gold went up, spiked up even much higher than it closed. And then a bit of a down day on the 21st, Thursday, and a little bit of a down day, about less than 0.5% on Friday. Looks like it's sliding sideways more and could be digesting that big up day on Wednesday and the big up days at the beginning of the year, starting on the 4th through about the 7th. So continue to pay attention. Gold is confirmed up move on the daily and on the weekly charts. So just continue to watch and pay attention. Derivative oscillator also rotated over on the 22nd. So something to pay attention to. That is where we are as far as the markets go. Now again, if you listen to our daily cast, you know that we are seeing how these up moves in the three indexes, that is the QQQ, which is the NASDAQ 100, the S&P 500, which is represented by SPY, and IYY, which is the total market. We've been paying attention to that up move over the last couple of days toward the end of the week, and if the market rolls back over, since we're in a confirmed down move on the big charts, we're going to want to see if we can get a piece of that renewed downward action if indeed it occurs. That's what we're looking for. Haven't seen it happen yet, but we want to see if it does. Now, lastly, let's jump into this one thing we always do in our weekly review and forecast. I know so many of you tune in for the news. We always say pay attention to the charts and not the noise, but it does bode us well to find out what happened in the last week and might have affected the markets and what news moving events may occur this next week. So let's jump in. And it is really interesting. Draghi, who is the man who runs the ECB, the European Central Bank, has said that they're keeping interest rates unchanged. They said this last Thursday, but oil and equity markets rebounded and the euro fell after the president, this is the Draghi fellow, hinted strongly that additional monetary easing may occur at their March meeting of the Governing Council of the European Central Bank. Downside risk have increased, they're saying, amid emerging market uncertainty with all sorts of geopolitical risks in the euro area, inflation continuing to be weaker than expected. So it's going to be interesting if Europe starts printing more euros and more monetary easing. It's just going to be fascinating. What's going to happen? Well, the markets are sucking wind and they don't want them to keep crashing. Okay, let's look at gold. Let's look at what's happened with oil. Oil has bumped back up after touching a 13-year low. Can you imagine? I heard the other day that actually the barrel that oil goes in costs more than the oil that goes in it. It has dropped that much. Very, very interesting. Oil did recover a little bit in hopes of additional monetary and fiscal stimulus in Europe, China, and Japan, and less aggressive Fed tightening. It recovered about $5 a barrel as the week ended on Friday morning. China is saying that they're going to put more regulation and intervention in order to tame their volatile markets. Well, of course, don't let markets correct on their own. No, get in and manipulate them. That's what the Chinese are saying they're doing. Again, good luck. U.S. jobless claims have hit a 7-month high. Not good news. Chinese GDP close to the government's targets, what they're saying. Well, we'll see. U.S. consumer prices dipped in December. The consumer price index fell 0.1% in December. For all of 2015, we saw a 0.7% increase in prices. Now, don't forget, they take out food and energy, things you must have, but that's not the way they calculate consumer prices. You take out food and energy. Well, I guess it would be better than it otherwise would sound, even though food prices have been soaring, energy is down substantially. But the sluggish inflation measures call into question the need for additional Fed rate hikes is what's being spewed out there in the market. Pay attention to that. The Canadians, what are they up to? Well, the market expected the Bank of Canada to respond to the ripple effects of the oil glut by cutting the interest rates at its March meeting or signaling a future cut at their upcoming meeting. It did neither. It's apparently going to wait for the newly elected Liberal government to unveil its budget in the spring, but the spiraling import prices as a result of the weak Canadian dollar may have influenced that decision as well. So very interesting what's going on in Canada. Okay, what's going on as the week starts? That's where we came from. Let's talk about what might be affecting things. Well, on Monday, German business sentiment's going to be reduced. That'll be interesting to see as what kind of effect will it have on the market. Probably not much of one unless things are like really, really bad. Then it could, because of course Germany is the key driver of the European market, right? Yes. Now on Wednesday, we're going to see the Federal Open Market Committee is going to meet. That can always be interesting, so pay attention on Wednesday. Don't be fooled by something crazy happening. The Fed doesn't like to act crazy, but anything they say the markets can glom onto and can really affect what happens. So that's a day to pay attention to what the Fed's up to and what might be coming out. So keep your ear out on that if you are in any kind of virtual trade. Again, we don't give advice on real trades. Our advice is all based on you doing virtual trading, learning how to do this, and then you make your own decisions on your own. We're not a stock calling service, we're an education firm. Okay, what happens toward the end of the week on Thursday? U.S. durable good orders are going to be announced for December, and the U.K.'s fourth quarter gross domestic product is going to be released. You know, the UK's been sucking wind lately too. That might be something that's going to have some negative impact. And then lastly, on Friday, U.S. fourth quarter gross domestic product is going to be released. So pay attention to that in particular. Also, toward the end of the week, middle of the week on Wednesday with the Fed meeting, end of the week with our own GDP. Depending on if Monday starts off and the Germans have some bad business sentiment, that could start the week off with sort of a fizzle, and we'll see how the week ends with U.S. GDP. So that is where we have been, my friends. That is where we are on our weekly charts. That is where we are on our daily charts. And again, if you've not signed up for and aren't receiving every day our daily review, you need to. You need to have that. You also need to make sure that you sign up for our newsletter, which will give you that every day, along with our charts, which we'll share with you, our charting layout from freestockcharts.com for free. Okay, we'll give you our layout, plus you can use it at freestockcharts.com. And lastly, we'll give you a link to our How to Read a Stock Chart video. It's only 15 minutes long, and it is the down and dirty, just what you need to get yourself kicked off right in being able to figure out the roadmap so that when you sit around, you're not making any of your decisions on anything but what the market's telling you, not what the talking heads are saying. Anybody who's dealt in that world and listening to that know that time and time again, if that's what you listen to, you usually get hammered. So make sure to learn how to read a stock chart, to pay attention to what you see in the stock charts. We so much appreciate you being with us as we go into this new week. Thank you so much. We love to hear from you. Follow us on Facebook, Twitter, Instagram, YouTube, you name it, we are there. God bless you from chartingwealth.com.